I think for people in their 20s, 30s and 40s, genuinely the aim is we just need to grow this money. We need to grow this money as fast as we think is kind of sensible without kind of going crazy with the amount of risk we take.
Why do you de-risk in the first 5 years then?
So we don't de-risk.
Well, you tap the brakes through.
Don't tap the brakes.
What do you call it? The first 5 years.
So we've got a foundation phase.
Foundation phase. What is that then?
So the aim of that is a lot of the people in their kind of 20s, this will be the first time they've ever saved in a long-term savings vehicle, like a pension. The biggest contribution to your pot for the first 5 or 10 years is whether or not you contribute. Doesn't matter what investment return you get, because there is so little money. First year you're putting in £500. You get 10% return on that, or you get 2% return on that. It doesn't make that much difference in the long term. We also did a load of kind of behavioural research into what people thought about risk and loss and returns and things. It was really, really, really interesting. And it kind of backed up a lot of behavioural theory about, it's called prospect theory, this idea that people are twice as concerned about losing money than they are about gaining kind of money.
A loss feels worse than a gain.
Yeah. And when we kind of looked into this, there was a real age kind of bias. And when you spoke to younger people about, well, we could put you in a pension scheme and this could happen and this could happen and stuff like that. But, in the long run, it'll all be fine. And we kind of mocked up things like kind of newspaper headlines like stock market crash. And we sent people mock benefit statements saying, oh, your money, you've lost 20% or 30% or 10% or something like that. Really trying to test, nobody likes losing, but what are the kind of triggers? And what we found with young people was the emotional kind of reaction to the idea that they didn't really know what this thing was. They've been kind of put into it. They've got loads and loads of other things they want to be spending their money on, but, fine. Somebody said it was a good idea and stuff. And then we've told you that you've put all this money away that you weren't that bothered about doing, and we just lost 20% of it. And the kind of messages were, that's it. I would stop saving. I would never save again. And I would tell everybody I'd ever met that I'm not going to save in a pension because this is an absolute kind of con. So we've got this kind of behavioural information. Whether or not people would do that, it's difficult. You can't really test that because you don't want to make people lose money. So this is all kind of theoretical. And then when you think about kind of different investment strategies you can take, whether you traditionally, the idea is, if you're young, you can take a load of risk because it'll all work out in the end and markets go up and down and then it comes back and stuff, which is fine, provided you keep saving. If you stop saving, you miss out on all of that. So the idea of the foundation phase is, can we reduce some of the volatility? And when we're talking about volatility, we just mean the ups and downs and stuff. So it's not saying you're losing this money. It's like if you do own a house, the value of your house might go down and stuff, but unless you're selling it on that day, it's a paper loss and things like that. So we spend lots of time thinking about how can we still get really, really good growth, but reduce some of that volatility. Early on, when we kind of first started out, the best way of doing that was just putting kind of slightly less in equities. So instead of putting 60 or 70% in equities, we were putting kind of 40 or 50% in equities and more in kind of lower risk assets. As we've got bigger and we've started investing in things like infrastructure, in property, what we call kind of illiquid assets. So if you think about a house, it's quite an illiquid. It's quite hard to sell on a day-to-day basis and things. It's even harder to sell a wind farm on a day-to-day basis. This is a 40-year investment that should be kind of throwing off income. So for younger people, instead of just putting more in these kind of safer assets, we're putting much more in illiquid assets. So long-term kind of great kind of return kind of prospects, but lower volatility. And the whole aim of this is not to make them have less money. The whole aim of that is to get people confident in the savings habit, that this is a good idea. I like what's happening with this money, without kind of giving up the potential for upside. So it's been kind of, at times it's been characterized as, we just stick everybody in cash for the first 5 years. Completely not true. We always stuck people in growth assets. It was just in a lower proportion. Now, because we're bigger and we can do kind of smarter things, we're giving people much more access to these kind of assets that, you don't need to sell them for 40 or 50 years and you'll just get that kind of steady return.
Does it
for a long
reduce
time.
expected returns in that period, the foundation period?
Very, very minorly now.
It does.
A little bit before when it was more of a bond equity kind of shift. Now we're moving it more to kind of a liquid.
Because the bond equity, I know you said like it's not de-risking. That is de-risking, right? Moving from 70 to 50% is a traditional way to de-risk a portfolio,
Yeah,
So
I mean, it's not de-risking because they were starting in that place.
No, I get it. But what I think about, so sometimes I think you can kind of overstudy things, and you can go out to the market and you can ask the kids or the 20-year-olds, if you lost 20% in money, how would you feel?
Yeah.
And they'd be like, oh God, I would pull it out. But these people aren't even logging on because only 70% of people never log on to the thing. They're auto-enrolled in, they have no choice, and they're not engaged. So why not, when they're not doing that, get them the return, like chase?
Yeah, I mean, the returns are marginal, and it's a kind of it's a trade-off between the most important thing, probably for the first 10 or 15 years, is you keep contributing. That's the thing that dominates your pot for the first 10 or 15 years. It's only after then that the kind of compounding effect and the returns that you get really, really kind of start making a difference. And it's kind of, I mean, I've had these debates a lot over the last kind of 10, 15 years. That we've modeled this over and over again, and the difference in outcomes from having a slightly lower risk start early on, and we're not even doing that now, is so marginal. It was like 1 to 1.8% at the end. It was such a small difference.
One in total value of pot or average annual returns?
Total
Okay,
pot.
I was going to say 1%
really
average annual return would be a big difference. 25%,
yeah. And it's that.
We won't know until we know, though, right? We'll never know. Like, you got to go down the path before you kind of know where it ends up.
Absolutely. And then the big challenge as well, and this has been kind of put to us as well, there's no counterfactual, because you could say, oh, well, nobody's opted out. And we go, well, of course nobody's opted out because we had this foundation phase.
Yeah.
Do you know what I mean?
And you could test it, but then the people who opt out, they're gone. And they, That was a clip from our conversation with Paul Todd, who's the Chief Operating Officer of Nest Invest. If you want to see the full conversation, you can access that right here.
I just found out I have a pension with Nest. I did.
You did?
Yeah, I did. It's true.
Loads of people probably don't know that they've got them, to be fair.